Hello, I'm Robert and welcome to my channel where I discuss everything automated algorithmic trading or simply algo trading. Last week I published a video talking about where I took 750 trades using a very aggressive technique. Well, in this video I'm going to go through and conclude that test with a total of 1,660 trades. Before we get into the meat of the video though, I want to take a few minutes to introduce my new store, where I bring art to everyday objects. If you are in a place like where I live, where winters are cold, dark, dreary, and dank, then having a little bit of art on something that I commonly use just helps brighten my day, and it really is a nice little reprieve from the dreadfulness of what winter offers. So be sure to check out my store at rapmd.org and take a look at my growing amount of art on essential items. Whether it's a pillow, a shower curtain, or even a blanket, or even something like a towel, like this beautiful, gorgeously colored seahorse, or even a yoga mat, or a desk mat. A little bit of art can really brighten your day and just make you feel better about the day when the weather is just not that cooperative. So check it out and be sure you use the holiday code and get 10% off of your order. Okay, let's get into this. We are looking at EURUSD, where I finish up my trading cycle. And we can see that the process is aggressive, very much so. But even with the aggressiveness, the reduction algorithm is working beautifully. Now here is the thing about this technique that really makes it so impressive. For every single profit I take, I deliberately take a loss. And yet, as you can see from the information, I am making money. The trick to that technique is my loss is 1 unit of my oldest position that I'm trading. So I'm slowly reducing my oldest position unit by unit as I'm taking full complete profits. So as I completely sell off a full position, I'm reducing my oldest position by 1. Now as you can see, sometimes you don't get a lot of profit and you end up taking a minor loss. Sometimes you get a good profit and the loss is completely absorbed into it. This is actually more often the case. In particular with this trading approach, it made $100. That's after all of the deductions of the losses it took along the way. $100 of actual profit, deliberately taking micro losses with each and every profitable trade. So the process and the theory is something that really works. It has its risks, which is why you see very small sizes being used. But those risks on very small sizes is incredibly profitable. And a trick that really makes this system work the best is to make sure that your unit size is significantly larger than your reduction amount. Now, of course, you need to experiment and run this in a demo account to get those numbers appropriate. But this is without even thinking about compounding or even looking at the rough basis of how the aggregations are going to work over the course of a year. So I'm looking at roughly a 36% yearly APR win rate just with a fixed amount. If I was to add compounding and other factors at this level, this would actually do very good. Now let's move to USD Canadian. And you see here the same situation. Tiny profits, tiny deliberate losses. Every single profitable trade is met with a deliberate loss. And as you can see, these trades, they're doing very well. And the losses are completely absorbed in them. But out of 1,600 trades, if I have a position that is, in this case, 613 units, I've sold off at least 2 full trades through micro losses. That means they've gone completely absorbed in while I'm making profits. That means my whole grid is now more dynamic, is now more capable of flowing with the market in such a way that I'm actually able to absorb in and raise the bottom of my grid as I continue in a trend of a sideways market. So if the market is really going in a sideways position and trending that way, I am literally eating up all of the positions that could potentially cause me losses in the future and coming out making money on top of it. This is the best case situation where giving a little bit back to the market is bringing in huge profits along the way. I am actually making the whole grid forcefully move to fit the market so that if I do get a large spike up, because I am whittling down my worst positions, that large spike against me isn't going to have as much of an impact. It also means that I can take very critical advantage of very tight ranges that normally wouldn't produce very much activity at all. Using this type of a technique with small positions is a wonderful way of really capitalizing on market madness. And you can trade at levels that even when the market really isn't moving, is still going to produce very good results. And as we can see here, this position took a loss, so I didn't do a reduction. This is the example of slippage, and slippage does hurt you, but because of the way the bot sets things up, it doesn't do a reduction and only carries on to the next trade. This trade did well, and it had a small reduction. And you can see in both cases, I held the position for 7 days. So as you use this kind of a technique, you can clearly see the benefits of just how well it works. But, yes, the dreaded but, this technique does have some very critical risks. When you're trading with a market that can move 30% of its entire position, there is the risk that a huge market move will literally shift the entire market completely out of the current range this bot is in. It will recover quickly and it will recover aggressively, but you're still going to take losses. Those losses are literally built into the entire framework. And that is what makes this technique work so well. Is if you really think about your budget and you deploy only 25% of it, you will produce a mechanism of profitability with a very high level of defensiveness. Probably more so than just about any other technique on the market. This type of aggregated aggressiveness is in and of itself an unusual layer of defensiveness, because what you're holding isn't allowed to run away, because it's always eating away every single position at the very bottom of the grid. So when you hit a large sideways run, this thing really makes up the difference in terms of building a huge buffer, so that when there is a big heavy run against your position, it can weather that kind of a situation. The other problem with this type of a technique that you have to be aware of is that you have to use it in a cyclical market only. If you're dealing with a market that is non-cyclical, don't try to short it. Use only long positions. For example, cryptocurrencies or stocks. Neither of these two markets are cyclical. If you look particularly at the stock market, it's always slowly rising in value. Even though it might have huge slumps here and there, overall, the market still strives to move to higher levels. So for a type of technique like this, you only want to use long positions in that kind of a market. Cryptocurrencies are much the same way. It's not really meant for a long-term shorting technique, whereas Forex is very cyclical in nature. That is, the markets swing up and down on a regular basis. So this kind of a technique for a short, long-term trade cycle is appropriate. So understanding the market you're working in is absolutely critical. Understanding how this technique works and why it works so well with such an aggressive state is also critical. Test it aggressively with a demo account, but you can see that it has huge levels of benefit when properly deployed. Even when the market isn't that active, this technique can still find profits. And that is a very critical point. So let me know what you think of this technique. Leave a comment, ask questions. And remember to check out my store and take advantage of that holiday code. 'Tis the season for some wonderful art and good trading. Remember, test, test, test. Don't deploy this kind of a technique without carefully testing it. Trade safely. Thank you for watching, and give this video a like if it helped you. Subscribe if you're not. Until next time.